Crude oil has been dropping steadily lower over the past 2 weeks since the Iran ceasefire was announced. But now there's something big happening on the charts that most people are missing. Let's start by looking at the beginning of this pattern. First, we had crude oil trading in a tight sideways range for about a month, consolidating until the war broke out. And the war broke out February 28th. And the very next trading day, notice this breakout here in crude oil above the range. Now, the chart and the news were aligned on day one. But here's what matters. Traders who waited for the news to tell them what to do were already late. The breakout above resistance right here was the signal. The news was just the explanation for it, but the technical pattern was already there. Now, after the breakout, notice how steadily the price trended higher. Each pullback came into support of the 8-day EMA, and this is a key line in the sand we look at for strong uptrends. Typically, each pullback will find support at this 8-day EMA. Here we had an undercut, which is normal, one-day undercut, but the price respected the 8-day EMA and continued higher. Now, after several weeks of trending higher and holding this 8-day EMA, we eventually sliced through the 8-day EMA, but came into support of the 20-day EMA, this blue line. And that's a really crucial level that we teach our traders to follow, because in a steady uptrend, pullbacks to the 20-day EMA often represent a relatively low-risk buying opportunity. And you can see here how the price action perfectly held that 20-day EMA, and then that was the impetus to spark a rally to another higher high. And you can see that the price continued higher. We stalled out here just shy of the prior highs, though, a few weeks later. And then news came out of the ceasefire. And after the news of the ceasefire came out, the price started to go back down. And eventually, we broke through this 20-day EMA and came all the way back down here and with capitulation. Now, this is the area that I want you to focus on right now. This is really important. Notice this yellow horizontal line. Okay, this marks the swing low support of this prior low from back on March 23rd. And that's a pivotal support level. So also take a look at this red line. This is the 50-day moving average, which is an intermediate term trend indicator and a very reliable signal for pullbacks. And you can see here what happened was we undercut. This is called an undercut, where the price dipped below both that horizontal support level and the 50-day MA, but the price only went below it for one day and then right back above it. So that's called an undercut when you get the price dipping below an obvious level of support and rebounds within 1 to 3 days. And that's a bullish signal that we look for confirmation for a potential entry after we see that. Now, this is also what we call convergence. When we have more than one support or resistance level meet in the same area, that's called convergence. And the more support or resistance levels you have converging in the same area, the more powerful that support becomes. So this prior low in this 50-day MA support was really key. And this actually is what got our attention when we first saw this undercut. It was too early. We don't buy while the price is still falling, but it got our attention. Now, another thing I want to point out here is the volume. Notice how the volume was lighter on the pullback. Right? We had one distribution day here, this first big down day, but then all the other days lower came in lighter than average volume. All right, so compared to the higher volume on the way up. So that's a sign that we weren't seeing heavy distributions in the market on the way down. All right, so we had the buyers took a rest, but it wasn't like the sellers stepped in and started heavily selling. Now, let's take a look at what happened next. Now, at this point, most traders were glued to the headlines: ceasefire talks, supply fears, geopolitical noise. But the reality is the chart was telling a much more precise story. This pattern you see right here is all you needed to know. And this is why we say the chart leads the news. The news said chaos, but the chart said this was a flush and a reversal. Two different stories, and one of them is tradable. The news was chaotic, but the chart was readable. So let's look at what that setup actually is. Now, when we get this undercut of a major level, we typically wait for the confirmation of the price to go back above that level. And that happened the very next day. Notice we had an inside day where the high and the low of that day was contained within the prior day. And then the next day, we had an up day. And we ran into resistance of this 8-day EMA, but that got our attention because it's confirming now that this 50-day moving average is going to hold. Right? So that went onto our radar as soon as we saw that. And then we took a partial position as soon as the price broke out above that high and went above the 8-day EMA. We took a starter position. And then today, we just added to the position on confirmation of a breakout above this 20-day EMA, which is currently right at 93.63. When we first entered the trade, we kept our stop below the 50-day moving average and this horizontal support level to give it a bit of wiggle room. But now that the trade is following through and moving above the 20-day EMA, we can tighten our stops more, which gives us better risk support on the trade setup. Now, for example, we can actually raise our stop to just below the low of this candle, below today's low, somewhere around the 90.7 area. So now that the price has moved out above the 20-day moving average, we can actually raise our stop to just below today's low, which also puts our stop below the 8-day EMA. We wouldn't want to see the price come back below today's low because that could be a failure at the 20-day EMA. So we can keep a real tight stop, which gives us a nice risk reward on the trade below today's low, plus some wiggle room. Now let's look at our potential upside targets on this swing trade. We mentioned that we can have a real tight stop below today's low, which gives us a sufficient risk reward for our first target, which is the around just shy of the $100 area. We've got resistance here from horizontal resistance from the prior highs and right around $100. And we've also got the 50% Fibonacci retracement of this move right around $100. So it might be a good idea to take some profit and sell into strength. We're looking to sell about a quarter to a third of our position into strength on this first target test. And then if the price action consolidates and holds up, continues higher, the next target we'd be looking at would be to take some more profit around the 106 area, again, which is the 0.618 Fibo retracement, as well as some horizontal resistance. And if the price continues higher and we get a little pullback and the price action remains healthy, then we could even potentially see a test of the highs from this whole move. And obviously, that's a key level. If we break out above that, it's blue sky and price could continue much higher. So we probably won't close out all of our position if the price makes it up here. We'll close out most of it to lock in gains in the resistance. But if we get a breakout, we do want to continue to hold some of the position. And then we'll probably even look to add to the position on a pullback if we get a breakout to new highs. Now, you might be thinking if the war ends that the price of oil will never get up this high. And that could be the case. But remember, we trade what the charts show us. Trade what we see, not what we think. The charts are all we need to know, and the news simply gives us the reason for the price action in the charts. Now, one quick note before we leave the targets, and that is a quick look at the weekly chart. And you can see here that we drew this horizontal line that says weekly resistance at 95.03, and that goes back all the way to 2023. You can see we had a level of resistance here, which was a prior highs, and that's called market memory. Even though it was several years ago, it does act as a significant pivotal level that you want to keep an eye on. So we've got resistance there on the weekly chart right around 95.03. And you can see on the daily chart, that's just above the current level. So we'd want to see the price get above that to get a little more confirmation is what we'll be looking at, because that level could act as resistance in the short term. So let's watch how the price behaves when it gets there on this test. And if it clears through on volume, the path to the first target opens up. But if it stalls and consolidates first, which this first attempt did, that's normal. The move may just need some more time to digest at that price level. So as this breakout continues, keep a close eye on the volume. You want to see expansion on the up days, higher volume on the up days, and lighter volume on the down days. That pattern confirms that the big money, the banks, the institutions, mutual funds, pension funds, they're all participating in the move. And if volume starts drying up on the rally days, you see lighter volume and higher volume on the down days, that's definitely a warning sign worth paying attention to. So keep a close eye on this volume down here. So we'll post another update video on this trade when the first target is hit. So be sure to subscribe to our channel so you don't miss it. And also a quick note on execution, depending on what you have access to. Now, if you trade futures, of course, the cleanest play is just to trade the futures contract itself, which is CL. But a lot of you may not trade futures. So if you're not a futures trader, a real simple way to get some exposure here is to trade the ETF called USO. USO is the US oil fund. It does not track exactly with the price of crude, but it's actually got some relative strength to crude. Notice how, unlike crude, which undercut its 50 MA, USO held the prior lows and never even touched its 50, and now it's well above both its 8 and the 20-day EMA. So USO is the most accessible alternative to actually trading the crude. But the important thing here, base your entry and stop decisions on the CL chart, since CL is the underlying. So rather than looking at the USO pattern, we like to look at the underlying itself and base our decisions on what the chart is showing us on the actual crude futures. Now, one thing worth mentioning is I originally flagged this crude oil as a potential trade setup the same day that it undercut the 50-day MA. I mentioned it to our TradeQuest students in our Sunday night live session days before the breakout you're seeing now was confirmed. So students were actually watching this develop in real time. And earlier today, before the breakout officially triggered, I also posted a full trade idea in the MTG Tribe community, which is free to join, and the link is in the comments. So our community members had this complete setup before the move even happened. Now you're seeing this on YouTube after the breakout confirmed. But the earlier you're in the community, the earlier you can see these setups. So that's how being in the room changes the experience. And if you'd like to learn the complete methodology behind trade setups like this, the market timing, the entry logic, the position sizing, I cover all of that in a free 90-minute live masterclass. This is where the setups like this get taught before they trigger. And the link is in the description. And as always, trade what you see, not what you think.